Hi, I'm Leanna Baker, U.S. Deals Team Leader for Bloomberg News. Welcome to the Bloomberg Deals Summit. The first half of 2020 has been busy, with deal-making reaching record levels and some of the biggest mergers in recent history being announced, including mega deals like Time Warner Discovery, which the Bloomberg Deals team reported exclusively. Against that backdrop, we're thrilled to bring you today's program, which we hope you'll find informative and enjoyable. Before we get started, here's a few housekeeping items. First, I'd like to acknowledge our presenting sponsor, SS&C Intralinks. Second, if you experience any issues with audio or video quality, try to refresh your browser or use the chat box in the bottom right for support. You'll be able to submit questions during the interviews. Please do that. While we probably can't get to all of the questions, we'll do our best. To submit one, please click on the Q&A box on the right-hand side of the video window and type. We'd love if you'd engage with us on social media using hashtag Bloomberg Deals and with other attendees in the event chat in the bottom right corner. And now let's get started with our first session. Please join me in welcoming Kim Posnett, the co-head of Goldman Sachs and the global head of Goldman's investment banking services. She's joined by our own Alex Steele.
Well, it's great to be here, Kim. It's a pleasure to see you, to meet you remotely. Thanks for doing this. When we were talking a couple weeks ago about prepping for the panel, what came out in our conversation was how there's a big distinction between the old world of tech, of IPO, of SPACs, of capital markets, of M&A, and then the new world. So I think, Kim, just starting off the conference, it'd be just great to get your perspective on what is that? What's the old and new world right now?
Alex, first of all, thank you for having me. I'm delighted to be here. I hope everyone's safe and healthy and enjoying the start to the summer. What a great topic, old versus new in the context of deal making. I would say in this new world, the pace of innovation has never been greater, yet I really believe it'll never be this slow again. And that frames how I think about all these themes across tech and media convergence, around capital markets innovation, around technology evolution. So I'm happy to have this conversation with you. Really excited about it.
So to that point, what do clients, what do investors, what do they want to see today? What are they digging into now versus, say, pre-COVID?
So first off, the scale and impact of tech companies has never been greater. We're seeing technology and innovation disrupt industries across the world, and companies are using innovation to create value. And so what do investors want to invest in? They want to invest in companies that are fundamentally changing the way we work and live, that companies that have differentiated technologies, product, content, companies that have wide scale user adoption and unit economics that support that, market leaders with large global addressable markets with deep competitive moats. And something that's not new is that investors are looking for long-term durable growth. They're looking for profitability and they're looking for cash flow. And to answer your question on COVID, that's obviously the major difference over the past 1.5, 2 years. And COVID has accelerated some business. It's battle-tested others who are emerging stronger. But I view COVID as having accelerated tech trends that were already underway, and it just sped up adoption of those trends. So I'll give you some examples. People who hadn't previously shopped online, banked digitally, bought their food or groceries online, looked for healthcare solutions online, all of a sudden they did. All of a sudden, people were staying at home more. People were using their phones and mobile devices more for media and content consumption. So that changed consumer behavior. And so not surprisingly, you saw, huge outperformance in certain sectors like gaming, e-commerce, FinTech, digital health. That's just to name a few. But those are some of the sort of immediate beneficiaries of COVID in the past year and a half.
Yeah, I literally don't carry cash anymore. Like I've been to a bank, I think once in 18 months or something crazy. The other thing I don't do is watch TV. I just go right to streaming. So I think a huge front and center theme, and this goes right to your wheelhouse, is the convergence of tech and media and sort of where we were 5 years ago versus where we're going, and kind of like how much more consolidation, how much more change can we see in that industry?
Yeah, so Technology has absolutely changed media, but the one thing that hasn't changed in the media industry is that content is key. And so two things that I've observed, premium content has never been more valuable, but at the same time, we're seeing this powerful emergence of the creator economy, okay? And that's because anyone can be a merchant now. Anyone can be a content creator. Anyone can be a content distributor. And consumers also have many more media options, to your point. They have their content library in their pocket at all times, and they can consume media when they want, how they want, through whatever device they want. And so I think the traditional media companies and the large cap tech companies and the streaming companies are all trying to figure out how they become the direct-to-consumer platform that consumers can't live without. And there's actually two deals that recently announced that I think speak to these, or they illustrate these trends, Alex. So, the Amazon MGM deal, that deal underscores that there's a real scarcity of high quality scaled assets in the media space, and how critical depth and breadth of content is in attracting direct to consumer subscribers. And in buying MGM, Amazon bought thousands of hours of movies and TV from decades of content creation and used that to sort of complement and supplement their original content. So that's one example. The other example is the AT&T Warner Media Discovery deal. That deal signals that scale and content and this evolving consumption methods will be the key drivers for success in this global direct-to-consumer, streaming landscape, if you will. And, that's a clear case of two high-quality players recognizing that if they came together, they'd be better positioned, even though they were already individually very well positioned, they'd be better positioned to compete and win, on this global playing field. And so I think the headline around tech and media convergence is premium content is more valuable than anything, but also there's this powerful emergence of what I call the creator economy, where really anyone can create content and have access to hundreds of millions of people and audience around the world because of these disruptive tech platforms.
So if we look at, say, the next 12 to 18 months, is the bulk of the activity going to be in this tech and media space? Or is it going to be in different kinds of sectors? Do you have a read on that yet as we're coming out of COVID?
I think that you're seeing with some of these deals, you're seeing clear signs of CEO confidence. You're seeing clear signs that CEOs are looking at tech disruption and innovation and ways to innovate their product, their service, their content to get to the consumer in the way that he or she is now consuming content, and or engaging on commerce and other technology sectors outside of media. So I think that that's where you'll see most activity. And, streaming is in the middle of all of those themes. And so I expect to see a lot of activity across tech and media convergence. Absolutely.
Do you have a sense of what could disrupt that kind of flow right now?
Well, listen, there's a regulatory overlay. There's, how big can these large scale tech platforms get? There's, the ability of independent creators to compete directly with premium content, and, will broader consumers be interested in both? I believe they will. And so those are the things that I think will impact the evolution of tech and media convergence. I do think that the large cap tech players, they want to own more and more of the customer wallet, and mind share is critically important. And the other thing that I think will disrupt this evolution is that, the data and marketing available through content consumption is incredibly valuable across other lines of business, whether you're a tech company or a media company. So that's something I also spend a lot of time thinking about.
That's interesting. The other part of this world is what's happening in the IPO market, direct listings, SPACs. Everyone I talk to wants to know from you, what do you think the market's going to be for SPACs? How do you see the world of IPOs and SPACs evolving?
No one's asked me that before, Alex. So
everyone's asking me to ask you. So
I know, I love it. But listen, I think, and that's, you and I have discussed this, I think capital markets innovation is only a good thing for companies going public. Period, full stop. The reasons that companies go public have remained the same, but the ways in which they can get public have evolved. And so companies have many more options today than they did 5-10 years ago. They can design how they get public to suit in a bespoke manner that suits their individual needs and desires, objectives, and goals. And I think that we at Goldman are fortunate to have leadership position across IPOs, direct listings, SPACs, and I'll get to SPACs in a second. So we're agnostic to the path, and we can work closely with our clients to help design their public listing path that, as I said, best suits their goals and objectives. And so, the thing I would say, just to put this in a little bit of a historical lens, and I'll get to the SPACs, is direct listings, in my opinion, were arguably the big innovation that kicked off this recent wave of capital markets innovation. And I do think that direct listings I don't think that they'll completely replace the IPO. I think that we'll have a healthy mix of both. And the reason is that, as I said, people are solving for different needs when they list. And companies that are focused on direct listings, they tend to be less focused on primary capital needs. That's because historically it hasn't been an option. Now it is. They tended to be less focused on shareholder-based curation and selection, less focused on developing relationships with the research analyst community in a more structured and formal way heading into the IPO. The most important thing they're looking for is, price transparency, right? And so those have been the reasons that people and companies are biased to direct listings. Now, SPACs is, an incredibly hot topic, as we've discussed. I really think that's a real way for companies to get public, and I do believe that SPACs will endure. And, clearly there was this unbelievable surge in SPAC IPOs in the first quarter of this year. There were 300 SPAC IPOs from January to March. That's over 5 times more SPAC IPOs than in 2019 and significantly more than we saw in 2020. And I'd say the pace we saw in Q1 is probably not sustainable over the long term, which you're already seeing play out. So there were only 30 SPAC IPOs in April and May. And so you can see the market adjusting to a more sustainable pace that I think is, healthier, longer term for the market. And the other thing I would say is we're seeing a flight to quality in the SPAC market. I also think that's good for the market. It's good for the issuers. People are looking for the highest quality executive leaders, the highest quality deal makers, the strongest business networks, strategic relationships, the best operating and sector expertise, and the strongest investor relationships. And so the SPACs that have that mix of attributes, I think, will do well. And I also think that you'll see more VC and growth equity and private equity SPACs. These are great investors who are in the business of looking for the highest quality founders and CEOs and businesses. And that at its core is what a SPAC is and what a SPAC does.
Do you feel like there's going to be certain sectors that these kind of VCs and SPACs are going to be targeting?
There's a mix. There's the generalist SPACs, there's healthcare-focused SPACs, tech-focused SPACs. As you know, I spend all my time in the technology space, and so that has been an incredibly robust space. I do think there will be a shift or a broadening of the SPAC market outside of the U.S. To answer your question with a regional overlay, this has been primarily a U.S. phenomenon. And, SPACs are a growing market in Europe. To give you a sense, there's only, let's call it a dozen SPACs that are looking for targets in Europe. About half of those actually listed in Europe, and then half of them are U.S. listed looking for European targets. And so that just speaks to the nascency of that market. And I just think given the less crowded nature of the European SPAC market, I think that represents a growth area for SPAC IPOs and in the de-SPAC market.
I guess my question with that is, if tech, FinTech, and all of that is sort of the hot area, it doesn't really feel very Europe to me. Like they're more old economy. So can the old economy do the new cool finance stuff?
I think that there's some great disruptive tech companies in Europe, and I think that there absolutely is opportunity for growth, innovation, disruption across the European tech landscape.
Mm-hmm. What have you noticed in terms of how SPACs are evolving? Like the Bill Ackman one from last week, when sort of how that was structured. I'm not asking you to comment on that specific one. I'm just saying like the structure and the way that SPACs are being done, the way the pipe investors versus are getting their cut versus the shareholders in the SPAC. How do you see that changing?
Well, so listen, that's definitely an interesting and unique structure. It's not a traditional SPAC merger, and it's a dynamic situation that's evolving in real time. So it'll be fascinating to see how that plays out. But I think that the broader point you're making is, SPACs are the ultimate example of capital markets innovation. And I think you will see continued innovation, across the market, whether it's IPOs, whether it's direct listings, components of the SPAC market. And I think, like I said, I think that's only good for investors. I think that a lot of people ask me about, what if you can't find a deal for your SPAC? Like, what will happen in that scenario? And, as I think all of you know, most SPACs have 24 months to find a transaction. In practice, if after that period the SPAC hasn't found a deal, they're supposed to return capital to the shareholders. And in reality, I think the answer is time will tell. And what do I mean by that? If you look at the 400 plus SPAC IPOs who are on the hunt for targets, the vast majority of those have only been public for under a year, meaning they're not on the tail end of that 2-year period. And so, time will tell, what targets they find and how the investors react to those targets. And SPACs are interesting because investors have a bunch of options to decide whether or not they want to participate and whether or not this SPAC and this merger is actually good for them. They can invest in the SPAC IPO, they can invest in the PIPE, they can invest in both. They have the option to redeem their shares if they don't like the deal. And so there's a bunch of options that protect the investor and give them choices along the way to see if that SPAC is the right investment for them.
So last question on this topic. Do you feel like then the traditional old school IPO where you do your road show and you market it, like, is that kind of done now?
I don't think so. I really think that there will be a healthy mix of deals across IPOs, direct listings, and SPACs. There are very concrete reasons why a company would want to do one versus the other. And so I do believe that there will continue to be traditional IPOs. Will there be a continued evolution and innovation around transparency for our issuing clients? Absolutely, yes. But you'll see a healthy mix over time across, I think, those 3 vehicles to get public.
And then the last kind of bucket that you and I spoke about that we wanted to tackle was kind of the old boardroom versus the new boardroom and sort of how those are evolving, but even more importantly from where you sit, how investors and clients want it to evolve that's kind of pushing the change.
Yeah, so this is a topic I spend a lot of time on. As we've discussed, boardrooms are definitely changing slowly but surely. I think the business case is simple, actually, that diverse boards lead to better governance and stronger performance. That, in its essence, is what investors are looking for, stronger performance. And so at Goldman, we're taking this very seriously. First last year, in January of 2020, we announced a board diversity initiative where we wouldn't take a company public unless there was at least one diverse board member. This is in the US and Western Europe, unless there was one diverse board member. And starting this year in July, the minimum goal is actually 2 diverse board members, one of whom has to be a woman. And so the other thing that I highlight is that we're actually a living example of this commitment. More than 60% of our Goldman board is diverse across gender, sexual orientation, race, and ethnicity, and that includes our lead director. We recently added 2 women to our board, and I believe we have significantly benefited from having those diverse backgrounds in and around the board table and their perspectives. And again, the business case for us is quite simple. It leads to better governance and stronger performance. And we're happy to be in a leadership position here. There's obviously a long way to go on this topic. And so one thing that we've done related to this, Alex, is our corporate board engagement team. So, we realized many years ago that our clients were facing the same challenges that we were facing in terms of identifying and sourcing diverse board candidates. And so, we realized that we uniquely are in a position to help match supply and demand, if you will, given all of our relationships across the business community. And we could connect people to each other in a bespoke and unique way, given the situation. And so we've now made over 20 board placements in the past year, and that's across all industries. That's pre-IPO, that's public. And we're very encouraged by this early momentum. Like I said, there's still a very long way to go, but hopefully that answers your question. And investors absolutely are focused on this.
Well, and then to that point, it becomes about not only increasing diversity, but retaining the talent, keeping the talent, promoting the talent, and the like, which kind of brings me to my last topic, which is you're clearly in the office. I'm in the office, and all of that, retaining talent, keeping them, helping the junior bankers, helping the newly hired, like all of that. Are people in the office? What's it like? What do you expect going forward?
Yeah, so also a topic that we've been thinking about very carefully for a long time now, and the answer to that obviously changes depending on the region you're in and the office you work in. There are parts of our business and our community that are still heavily impacted by COVID, in India, in parts of Europe, and so the dynamics vary quite dramatically across region, which right now I'm at 200 West. I'm in our headquarters, and it does feel different. We believe, given our culture, it's an apprenticeship model. It's a teamwork oriented business model. Collaboration is critically important. Communication, and we think it's important for people to be physically together to drive, apprenticeship model. And so, we've seen, increasing number of people in the office. I think it's great for collaboration. It's great for the culture. And so
Kim,
yeah.
What about clients? Like, are you traveling? Do clients want to see you guys, not on Zoom?
So absolutely. Listen, it varies. People have different degrees of comfort, and they're in different stages of, their evolution post-COVID. But I would say many clients are thrilled to see us, and I'm absolutely traveling to see clients, and I think it's also created creativity and innovation actually in how we engage with clients. Not surprisingly, a lot of my client meetings have been outdoors over the past year, and I've had meetings with clients in environments that I wouldn't have thought of before. And so I think it's created sort of an intimacy and a creativity and an engagement with clients that's actually quite compelling.
Well, Kim, we got to leave it there. I mean, I could talk to you for a while, but I really appreciate your time today. It was great. It was a good setup to the rest of the Deal Summit. So, Kim, thanks so very much.
Alex, thank you.
Hi, it's Leanna Baker, U.S. Deals Team Leader at Bloomberg. I'm back with our first panel discussion of the day. Please join me in welcoming three major deal makers who will talk to us about how to do a mega deal. Here with me is Marc Brown, partner and head of EQT Growth at the private equity firm EQT Partners. Before he joined last fall, he was a longtime deal maker at Microsoft. He worked there for 20 years and led more than 185 acquisitions. We also have Michal, head of investment and corporate banking at Mizuho Americas. She joins in 2019 from RBC and oversees all banking activity in the Americas, including industry and financial sponsors coverage, debt and equity capital markets, and M&A. And finally, Scott Barchet, chair of the corporate department at the law firm Paul Weiss. He regularly advises on some of the largest deals, including yesterday's multi-billion-dollar take private of data center company QTS by Blackstone. To get us thinking about all the activity, let's pull up a chart on M&A volumes. Michal, you're the investment banker. It feels like we're on track for a record year in M&A after the strong first quarter of the year. Can you set the stage for what's happening in M&A right now?
Thanks, Leanna, and good morning, everyone. So, we're almost at the halfway mark of 21, and I'd say what a difference a year makes. The pace of M&A activity in the first half of this year really kept pace with the back half of 2020. And it really is the rollout of the vaccine, the fiscal stimulus. It's still in the economy, and the opening of the economy really removed a lot of the uncertainty that we saw in the first half of 2020. The chart you showed, year to date, M&A volume stand at around 2.5 trillion globally. The U.S. constitutes about 50% of that. That's 4x for the U.S. from same period a year ago. And this activity is very much supported by the constructive stock markets, the low cost of funding. But I'll tell you that with that comes that return of confidence by decision makers, CEOs, boards, and there's obviously an expectation of a infrastructure spending bill and consumers going back into the economy, which should continue to support a robust and active M&A environment. I would say there are also other factors that we're seeing this year that were, I would say, just more that they're first innings at the back half of last year. We're seeing more sponsor-led activity. So year to date, about 35% of M&A volume is sponsor-related. Also, the SPACs that raised funds last year, we have 400 or so odd SPACs that are looking for M&A targets. And so putting all that together, plus I would say just the overall financing environment should continue to support a nice level of activity across the board.
Speaking of sponsor activity, last weekend we saw a mega LBO, one of the biggest of all time with Medline. What are we seeing in the financing markets, Michal?
So, I'd say that there are abundance of financing options out there for both corporates as well as sponsors. Just talked about the stock market buoyancy, which, markets are at record highs, and just under half of transactions that have gotten announced have been stock only or a combination of stock and cash. In addition to that, you have the non-financial corporates, which are sitting at around, 1.6 trillion or so of cash on their balance sheet. And then we talked about private equity in terms of the LBOs. They have raised mega funds over the past couple of years and are looking to put that dry powder to work. In terms of the financing markets, they're in full recovery from where we were in the midst of the pandemic, both the loan and the bond markets, which are very much supporting M&A activity for both of those, I would say, acquirers.
Got it. Scott, you work across all sectors of M&A deal making. Which industries are you seeing as being especially busy right now?
So Liana, I guess it's easier to answer the other question, the opposite question, which is what sectors are slow right now, because basically it's busy across the board. Once we got past the middle of last year, tech and healthcare basically were leading the way. And they haven't really faltered, but as Michal was saying, as the vaccines have kicked in, as you see more confidence, basically all the other sectors have caught up or are catching up. So, you see a lot of industrials deals, you see a lot of FIG deals. We're seeing consumer and retail deals, which I don't think we ever thought we'd see outside of distressed, and we're seeing no distressed. So if you want to know what sector is slow, there's no distressed anything going on right now. Again, as Michal said, financing basically is almost free, and so there's a lot of people a lot of companies taking advantage of it. And then on the PE side, which is not really a separate sector, but is but we in this business really treat it as a subgroup of M&A deals. It's on fire, and PE shows no signs of slowing down. We're seeing, you brought up Medline. There's a whole bunch of others that have happened over the course of the last few months. I think we see a lot of dry powder that the private equity firms need to put to use, and they're putting that dry powder to use right now. And I 100% agree with Michal. We are not going to see a slowdown unless there's some gigantic change in the macro that none of us right now expect.
One of the largest deals so far this year was AT&T's spin merger of Time Warner with Discovery. That just came a few years after AT&T bought Time Warner for $85 billion. It's sort of an example of M&A not really working out the first time around. Marc, can you talk about how to integrate companies to be successful in a deal long term? I know that's something that you'd been involved in terms of bringing in big companies in the past at Microsoft, and those weren't sold right away.
Right. Yeah, I think the story on the AT&T piece of the deal is still yet to be told. We'll see what happens and what value creation happens with Discovery. I know the AT&T folks would take umbrage at the notion that this was anything but a strategic retreat, or like George Washington. But to the point on integration, which is really the key to really what we're talking about here, and is what I think in technology particularly is the most difficult part, because that's where you're dealing with people. So your resource does walk out of the office every day, or used to anyway. And then also, it is where your returns are primarily driven from, right? It is through the synergies, it is through the long-term synergies that you gain through the combination that you're really trying to use to support the buy case and drive value creation in your firm. That makes it really important, but also very difficult. And what we've ultimately came to is that you needed to be flexible. Flexibility is the key. You cannot have one model. You want to start with a plan. You want to see that plan try to run out. You also need to be flexible and constantly learning. And this goes to the Microsoft growth mindset, because one size does not fit all. So whatever you did on transaction A, it's not guaranteed to be different on transaction B, but likely to be different. And so you can go in with some notion of what worked over here can try to work over there, but you cannot guarantee that, because again, you're dealing with people and you're dealing with an environment that is so dynamic in technology that changes happen so quickly that you better be flexible.
Speaking of large transactions, before you can integrate them, they have to get announced and get to the finish line. So this one is for all of you, starting with Michal. What do you have to do to get a mega deal to the finish line these days?
So, some of the stuff we talked about, the market backdrop and the funding, I think those are just kind of the mechanics. I think at every M&A transactions at its core, you got to have an industrial logic, the reason for doing the transaction. And does the transaction make sense? Does 1 + 1 equal more than 2? Are you is there this alignment? Is there a common vision? I would say there are a couple of things that particularly are, I would say are underrated, is that there's no room for hubris when you're doing a transaction. So whether you think about who's going to be the forward-going CEO, like who's best positioned to lead the combined companies, and when you have a CEO that was successfully taking a company from point A to point B, may not necessarily be the right leader to take or to run a larger conglomerate, so to speak. There's also the decision to buy or to sell can be very emotional. And so recognizing that is important. In terms of actually getting it done, I think familiarity is also something that's kind of underrated. What I mean by that is that companies that have tended to have existing relationships or partnerships, whether it be joint R&D or go-to-market strategies, and there is knowledge of the inner workings and the cultures across organizations, are really important to not just actually getting the deal done, but the integration and the execution of the transaction post-announcement. And then the last thing I would say is, we talked about industrial logic. Marc talked about people being really important. And the one thing is that I would say is you got to think beyond the merger. And I'll make the analogy, which is just like it's really important to be ready for the marriage post the wedding day, it's really important to plan for the pro forma combined new company after the day of announcement. So those are a couple of things that I would highlight.
Thanks, Michal. Scott, do you have any thoughts? What happens if a deal leaks before it's announced?
Yeah, so Michal did a great job on the strategic side of this, right? What what do you have, before you decide you want to do a deal, a buy, a sell, an MOE, what do you need to be thinking about? So I'll now take it down to the more mundane, the tactical side of it, of how do you get it done without it resulting in a complete disaster, and so you bring up leaks. It's actually interesting, under COVID, I feel like there have been less leaks. There just seemed to be less leakiness, and I'm not sure why COVID would have changed that, but I'm very happy to see it. I mean, the deal I announced yesterday went through right to announcement without a leak, and that was happening less and less. Leaks on mega deals as compared to regular deals can be an absolute disaster. It can throw off the valuations of the companies, so that either the acquirer stock price can go down if the market doesn't like the deal. If the acquirer stock price goes up, which happens less commonly because the market loves the deal, then it may feel like they're overpaying because it's a much bigger premium. On the target side, if it's a stock deal and the target stock price goes down, that's a vote of the market against the deal. And all that is happening when the two companies have not had a chance to explain the industrial logic, the strategic rationale that Michal was talking about, and that's a disaster. Plus, when you're on the buy side, that can result in what the buyers would call interlopers, and what others might call white knights. It could result in other parties coming in and competing for the deal, and it can result in employees and customers and suppliers going bananas and yelling and screaming. And then I've had a few times politicians come in and say, I'll let that deal go through over my dead body, and that's not good. That's not good either. So the advice I generally give my clients in these situations is twofold. Number one, be totally prepared before you even contact the other side, whether it's a buyer or a seller. Be completely prepared. Have done every bit of work that you can do without reaching out. And then second of all, speed is your friend and time is your enemy. So you want to once you engage, you want to get it done as quickly as possible, because the longer a deal is under discussion, the more likely it is to leak and have all the issues that we just talked about.
Marc, you've been behind the scenes on some of this. Any insights on how you get shareholders on board if it really is a transformational deal?
It's a conversation, and it's part of what Scott referred to as telling the story. And I'll get back to the leak piece of it. If a leak happens, it makes it sort of interrupts your plans of how you were going to tell the story. And in some cases, and Scott, you correct me if I'm wrong, you really can't engage even if it's leaked, which leaves all the uncertainty that Scott sort of referenced in his comment, which makes it even tougher. But whether it's shareholders or, as Scott mentioned, customers, partners, employees on both sides, the communication strategy is critical on big deals and small deals. And anything that disrupts that can be problematic. But being a good storyteller is critical to being able to communicate what, again, is not always the most obvious strategic logic that Hall talked about before, to all the audiences. And an important one is obviously shareholders of both companies. And so it takes upfront planning. It's another one of those things that Scott mentioned you need to have done before you need to do it along the way.
But also, based on your story planning, it needs to have some planning of the seeds beforehand as well. So whether it be in like your earnings calls or non-deal roadshows or whatever it is, just the intent of trying to do something that's inorganic or strategic. You can't just kind of spring it one day and then expect your shareholders or rating agencies to just be accepting of the story. So without talking about a specific transaction, I do think that telling of a story that Marc was was just talking about has to start in prior quarters, just laying out that groundwork as to what's to come when the right transaction comes along.
Yeah, investors don't like surprise parties.
Like surprises.
All great points. I'd love to hear your thoughts, Marc, based on your experiences on what is your take on big tech right now and whether the Apple, Google, Facebooks, and even Microsofts of the world can do sizable transactions without a lot of scrutiny from Washington. Can we see these deals happen?
Well, I think the basic answer is yes. And the regulatory environment has always been part of any calculus of any deal, and most big or small. But particularly on the big transformational things. It's another one of those elements that you have had to think about early in the process. You sit down with folks like Scott and his team and think about what the regulatory environment looks like. And it's not just in DC, it's a global issue now, and particularly in big deals where people have points of presence all over the globe. There's always, and maybe you're referring to now, there's a bit of a more political light shed on tech, and that happens from time to time, and different industries go through that on occasion. But the basic message is the same. Each deal does get reviewed, sort of on its own merits, and you have to be prepared for that process, both in terms of the quantity of information required to convince regulators of the purpose and benefits of the deal, but also the time element that it may take, and both parties need to agree on that element of it, because this is the environment where things can take a little bit longer, which is to the scrutiny point. People are I think, pausing a little bit more before deals can get through the 30-day period and avoid a second request, etc. But in general, I don't see or hear anything where there's an absolute prohibition of tech deals by the companies you mentioned or any others.
While we're on the topic of Washington, there's been some potential tax changes in the works. I want to turn to Scott for a second. Any thoughts on whether potential tax changes under Biden is affecting how buyers and sellers are thinking about deals right now?
Yeah, so I think if you go back to the beginning of the year, there was a strong sense that taxes, including capital gains taxes, were going to go up very significantly, and we had a lot of clients talking to us about, should we be selling now? Will they be retroactive? Will those tax changes be retroactive? And there are definitely deals that have happened this year that were affected, that have been, that part of the impetus for the deal was potential tax changes. My sense is that is calming down a little bit, and that there's a little bit less of it. I think, as there's a sense that the tax increases may not be as big as people originally thought they might be. So that's still a TBD. But there's definitely some movement, especially where you have large individual shareholders thinking to themselves, if I'm going to cash out for a big gain, better to do it this year than next year.
Michal, is that what you're seeing too? Do you think there's been deals this year so far motivated by this?
I think folks are definitely thinking about it, but at the end of the day, you need a buyer, you need to have a willing seller, and you need to have an agreement on a deal and valuation. And so there's just so many other factors. I would say that it is certainly one, and there may be an acceleration in I would say in the near term. I would agree on that front.
Got it. Michal, just on that note, I know there's been deals in recent years like SAP buying Qualtrics and then spinning it off into an IPO. I know you like to call it a shrink to growth strategy. Could you tell me what you're seeing in corporate spinoffs? Is that still a trend that we're going to see?
Yeah, so part of shareholder value creation is not necessarily just growing for the sake of growing, just adding on scale. What we're also seeing is companies looking at their portfolio and looking to make sure what's core, what's not core. Can I optimize valuation? Can I actually sell or spin a division and use those proceeds to whether it be pay down debt or acquire a more strategic asset to advance and further the growth strategy? And so that leads to some of the divestitures or spin or RMTs that we have seen. And what that strategy allows a company to do is, one, yes, focus on the core business, but also it does provide that captive asset that was sitting within the bigger platform with an opportunity to redefine itself and to provide its own identity and brand, its own capital, access to capital, I should say, and perhaps re-rate valuation, particularly when you have a faster growing asset sitting within a more mature, slower growing conglomerate. I'll say, in addition to the Qualtrics, which is a great example of Qualtrics now having an opportunity to position itself as a standalone strategic asset, Scott and I had an opportunity over the past couple of years to work with Nuance Communications. And here is a company that tripled its stock price from 2018, from 15 to 45. And during that period of time, had sold off one of its divisions to a private equity firm, had spun off another division into a standalone publicly traded company, and revenues went from $2 billion to $1.5 billion over that period. Yet it had completely re-rated its valuation by 3x, and then this past April had sold to Microsoft at a premium for $20 billion. So here is absolutely a case of a company that shrunk and yet grown both in terms of valuation and shareholder creation, which is what we're really talking about at the end of the day.
You mentioned RMTs, which I think stands for Reverse Morris Trust. Scott, I know you're familiar with these. What are they? Why do we still see big ones every year? And why are they so hard to pull off?
So Reverse Morris Trust is a tax term, and these are very tax intensive. So an RMT is where you have essentially a company that spins off a division or a subsidiary, and then at the next moment in time, that division or subsidiary merges with a existing public company. And the tax issue is the shareholders of the shareholders of the spinning company have to end up with more than 50% of the stock of the combined merged company, the merger of the public company and the division. So these are very hard deals. These are very hard deals to pull off. The stars have to align in terms of market caps and share price, but they're done tax free. So it's essential, in a sense, you can do a divestiture. If you're a big company, you can do a divestiture, but not pay tax on the proceeds. So it's a great deal if you can do it, and that's all the financial and tax engineering, as Michal has been telling us several times now, and she's absolutely right. All that's great, but the industrial logic has to be there. The deal has to make sense. It just can't be financial engineering and tax. So they're very complicated deals. They're fun deals to do because they're divestitures, they're spins, they're public company mergers. There's a lot of good structuring that where you can create a lot of shareholder value, but only if the deal makes sense. And that's why when you don't see them that often, but when you see them, you often see the stock prices of both companies going up, which tells you investors generally like these deals.
And the most recent one we saw was the AT&T Time Warner Discovery spin, so definitely still very relevant. I want to switch gears for a second. Marc, I know you're involved in growth equity right now, which is a really hot area. Tell us exactly what that means and what sort of insights do you have in looking at what companies to invest in, since you've been on the other side with a big acquirer looking at companies to buy?
Yeah, great question on the definition, and it's definitely in the eye of the beholder. It means a little bit different things to everybody. What we think it means is it's really the expansion stage of a company where you're talking about providing capital and other resources to help it continue whatever initial growth it has. So after it reaches their defined product market fit and is going into that next phase of its growth, whether that's new market entry, M&A, or other ways of continuing growth. I wish I had a direct insight into all the different corporates about what needs and things that they would have. It would make my life a lot easier. What we're looking for are just great companies with great management teams, large, attractive market segments that can be, in some cases, disruptive because we're backing the companies that are doing some of the disruption. And then we focus on building those companies and let the exit take care of itself, whether that's IPO or an M&A transaction. Because I think the old adage that most companies are bought, not sold, is really true. And so being heads down about building a great company, a great organization, a great culture, and keeping your focus on that as your North Star, I think, is the ultimate thing. And those are the companies we're looking to back.
You mentioned exits. I can't, do an M&A panel here without mentioning the exit through a SPAC, which seems to be something we're still seeing a lot of. We're even seeing mega deals that are SPACs. There's been a few this year, over 20 billion. Bill Ackman is doing one potentially with Universal Music, which involves a Spark. Could we just go around and just briefly, if each of you could just tell me what you think we're going to see ahead in that SPAC market? Start with Scott.
I think that the SPAC market's has been and will continue to slow down a bit, but it will keep going. And I think you're going to see less of the deals where there's really no cash flow and really no business yet, those companies going public through SPACs. I think you're going to see less of that, and you're going to see a predominance of actually good, strong companies using SPACs to go public.
Michal?
I would say that SPACs are very much a valid alternative investment vehicle. We will continue to see them, but I do think the structures will evolve. And we're already seeing that. We mentioned Ackman and the new acronym, they added an R to a SPAC with a Spark, which is more of a right to participate in the acquisition as opposed to commit to it. But I would tell you that SPACs are not for every company. It's not for every situation, and it's not for every investor. And so that market is here to stay, but it will continue to evolve.
Marc, I'll give you the last word on this.
Yeah, definitely here to stay. And I definitely see a bifurcation on the sponsor side. There are going to be sponsors who can continue to do even some of the deals that Scott referred to of the no earnings kinds of companies, because I think the sponsor will be the thing that investors, pipe investors, and other investors look to. And then I also agree with Michal, it's not right for every company.
Got it. Well, thank you so much, Michal, Scott, and Marc, for your time today, and we'll see what's next in the M&A market.
SS&C Intralinks, preferred by dealmakers everywhere. 25 years after pioneering the virtual data room, we're still the leading innovator in financial technology, with more than 4.1 million registered users, $35 trillion of executed transactions, and almost 10,000 M&A deals every year. We're the global leader in virtual data rooms. Intralinks, a clear advantage.
Hi, everyone. Thanks for joining us. My name is Ken Bisconti. I'm the co-head of the Intralinks business, and I'm so pleased to be joined by Anu Aiyengar, who leads M&A for JP Morgan. Anu, thanks for joining me.
Good morning. Thanks for having me.
Anu, let's get right into it. Look, this has been a quick start to 2021. M&A activity's been, surging. We've seen regularly over 300 new deals on our platform every week, which is record levels. What do you attribute to these record levels of activity in the market?
Well, it is indeed a fortunate time for both our businesses. And if you look back a year ago at this time, it looked like the M&A market had come to a standstill. And then post-Labor Day last year, since then, we've had 6-7 months of record M&A activity, $400 to $500 billion of volume, announced volume every month. And it's really a combination of things. You have more political certainty with the vaccine. There's a lot of uncertainty in the system that has gone away, reopening of economies, and still you have decade-best equity capital markets, low interest rates. And so the combination of all these factors is enhancing confidence with CEOs and boardrooms, combined with the need for growth. And so really good ingredients for a very healthy M&A market.
Sure. And, of course, SPACs have been a hot topic. This year we saw 56% increase in SPAC volume coming into Q1, quarter to quarter. What's your viewpoint on SPACs as a component of that?
Look, SPACs as an asset class, I think, are very interesting. It gives an alternate way for people to do deals, because now you have a different type of counterparty where you can still go public, continue to retain control. And for some companies where you need to really tell a story and due diligence helps in getting to the right place on value, it makes a lot of sense. The first quarter, maybe it was a bit too much. About 20% of the market was SPAC deals. There were more than 100 deals that got announced. Many of them still need to close. So we've seen a pause now because the existing deals need to finish. The pipe market needs to digest it. There is more SEC guidance on increased disclosure, all of which I think is a good thing. So I'm hopeful that eventually this market will evolve and settle at a right place. And there will still be this asset class, but at more moderated levels.
Yeah. And, M&A can be hectic itself. Running due diligence virtually is, adding to that. We've seen use of technologies like, e-meetings where we have Zoom integration in our platform and video streaming that we're supporting. What do you see your clients doing for due diligence during COVID?
Look, it's really been amazing, right? Because you thought about the M&A as something where you have to physically be in the room, look into the whites of the other person's eyes. And now we've done M&A deals start to finish remotely. And it does take more effort because chemistry building and all of that does become harder over a remote platform. But technology has really been amazing. The ability to record management presentation, add color and context to that, showing the facilities in 3D. People can look at it in their own time. When you have cross-border deals and international buyers, you can add subtitling and translations to it to make it easier. So really, we've looked at this both as how do you overcome some of the impediments to M&A, as well as how do you look at it as an opportunity. And my takeaway from this is never underestimate human creativity. Because when you put yourself in a situation where all the traditional tools of M&A are not available to you, we find another way to do it.
Great insight. Any last comments? We're approaching the midpoint of the year. Any last thoughts about the future of M&A for the rest of the year?
Look, I think the conditions continue to be good. Because the equity markets continue to be strong, interest rates continue to be low, and most importantly, the investors are rewarding companies who are doing logical, strategic M&A. And even if companies are paying up a bit for growth, as long as it's logical, strategic, well thought out, and well planned, investors are giving the acquirers the benefit of the doubt. And so that I think, and buyers are being very disciplined as well. So the combination will hopefully continue. Now, risks would be regulatory. Risks would be any reemergence of another strain of COVID or something like that that puts a little bit of a halt, or continuing differences in valuation expectations. So some risks remain, but conditions are still very healthy for the M&A market to continue to be very strong for the rest of the year.
Great. Anu, thank you so much for those great insights. Really appreciate your time and your attention, your insights. Everybody, I hope you enjoyed the rest of the summit. Thanks for joining us.
Thank you.
Hi, I'm Shonali Bassick, Wall Street correspondent at Bloomberg News and Bloomberg Television. I'm being joined by Ken Moelis, entrepreneur and investment banker. He's been everywhere, Drexel, DLJ, UBS, before founding Moelis & Company right before the last financial crisis. And then most recently, starting up a few SPACs. So thank you so much for joining us, Ken.
Great to be with you.
It's hard not to start with you with culture, just because there's a record amount of deal making, yet people are still asking for so much flexibility. What do you tell people in this kind of environment, and how much can you really change?
Well, I don't know if you want to change. Hopefully, your culture is one that you don't want to change. So I've always thought the culture, from the day I started 40 years ago, that I've treated everybody around me with, was a high level of trust, a high level of delegation. Give people authority and give them some rope. And hire, by the way, start with hiring smart people, but then give them a lot of authority and a lot of trust. And it's always stunning to me what they can accomplish. And that was always our culture, not central, not bureaucratic, not top down. And so, look, when the crisis hit, it took us a second to figure out how we were going to do the technology. But I knew each individual, they already had the responsibility, they already had the motivation, and they knew we trusted them. And I think coming back the other way, we're going to do it the same way. We're going to have our offices have been open. They are open as of now voluntarily, and we think people can make their own decisions. We actually trust our people. It's worked well, and they'll make their own decision as to when and how many times they want to come back to the office.
That's interesting. So are you saying that 5 days a week may not be the norm of the future anymore?
Norm for who? It might be for me. It might not be for someone else. I think it might improve people's work, and people's work could deteriorate. And it's up to us to let them know how we're seeing. And I think for different people, it'll be different times. There is an importance, the office is a good place. It is a place where I've been in a few times now, and the conversations you have with people, the creativity you have is much looser when you don't have to wait, the pause of the second on delayed, no matter how good this Zoom is. But let people decide. I have really high faith that our team, each one of them, wants to be great, wants to service their clients in the best way they can, and we'll find that way. And by the way, Shonali, I'm also open to the fact that generational things happen. I'm of a generation that possibly a new generation of 30-year-old CEOs will even be more comfortable doing it via Zoom, doing a meeting, and actually, so who might impose that on our client that they have to come into the office? I think we're going to find out how things work, and then we'll be flexible enough to optimize around it.
You have been given a lot of responsibility yourself when you were a young banker, and you've been really known to hire young people, bring them up. It's been so much of a part of your business model. The young people that work at Moelis & Company today, what may they be asking for that's different than before COVID?
Well, probably, it's hard for us to see what's going on. So you're right. One of the things that drove my career, I remember being a second or third year associate. We went to pitch a deal. It happened to be for a casino in Atlantic City. Bally's was building of Bally's. And we won the assignment, and the head of the firm, a guy named Fred Joseph, said, they said, we don't have anybody to do this deal, Fred. And he goes, oh, maybe we'll give it to Ken. I was fast asleep because I was that guy who was up 2 days doing the pitch. And a day later, he was about to give it to some senior person. And I said, hey, Fred, I thought I was going to lead this deal. I was probably 23 at the time. And he said, Ken, our first job is to stay in business. Meaning I didn't know how to do a deal. But long story short, I did end up leading the deal. He let me do it. I learned more rereading an indenture start to finish than I ever did over and over to get it right. And I think those are the important, that's the important element of giving people early responsibility and giving them more responsibility than they think they can handle. The difficulty right now is we're not there to see if they can't handle it or they need a little help. Look, I don't remember, it's 40 years ago. I'm sure I needed help. I'm sure I walked into an office and said, what am I doing wrong here? That's the beauty of being near each other. I think it's harder to do on Zoom, and it's harder to find those people who are having trouble or overworked in their own homes. We just don't see them.
So I want to shift gears a little because you have such a unique perspective here into what's happening with some of these big meme stocks. Moelis & Company has advised some of them, right? You've worked with AMC before, you've worked with Hertz, your bankers have. So how has all of this crazy movement in the stock market changed the way you advise your clients?
Well, first, it'll remind you that there is no one oracle that knows all the answers. I'll tell you, we were advising Hertz a year ago. Many of you remember it was a deal that was frowned upon. We tried to issue, Hertz tried to issue equity in the bankruptcy. They had gone bankrupt, and the stock was still trading 200 million shares a day at $4 a share, things like that. And we said, well, why don't we just issue shares to finance? And if I remember the prospectus, it basically said, these shares are worth zero. We recommend you not buy them. And that didn't do anything to the stock. The powers that be, I'm not sure exactly how they stopped it, but they stopped it. They made us stop. Interestingly, two interesting points about that. Hertz is about to come out of bankruptcy now. I think the stock is trading at $6, $7 a share, which means the people we protected from themselves would have doubled or tripled their money. So sometimes the protector isn't really the protector. That's why markets are so great. They're markets and people take risks. And the other thing that I think, just to say what I think is going on in the general meme stocks, is people are missing the social part of what's going on. I get asked all the time, are they dumb? Are they not doing the work? And I think they're just having fun. I think 70 to 80% of this is fun. When you go to a casino, the most boisterous, loudest craps table is always the one where everybody runs over because somebody's made their point. They've predicted something. I'm going to make a hard six, and they make it 3 times in a row. Well, all of a sudden, half the casino's trying to put the money down on that table. I've been there. I think 70 or 80% of the people there aren't making an investment decision. They're making an emotional, social decision. Let's go yell. Let's have fun. I think on some of the meme stocks, I have my kids involved. Every half hour I get a rocket to the moon or an emoji or this one to the moon. I think you're in a global craps game where everybody's talking to each other and they're having a blast. And by the way, you get to go home, the market shuts down, and you get to go to a bar. I understand you go to half of these bars and the meme stocks are half the conversation. So it's just a lot of it's fun. Now, at every crap table, 70, 80% of the people are having fun and know they're going to lose their money and accept it. And there is somebody who's going to lose their mortgage or try to hitchhike home or lose their college fund. It's sad. I think a lot of the meme stocks are people having fun, and we don't analyze them. It's a social. It's almost what Roblox did, by the way. Not only do you have the creation of gaming online where you can talk to each other, but you have multiple creators. People, Reddit and the boards, people are trying to create the next game. I understand there's a couple of new games starting this morning in the meme stock world. And so you have multiple players and you have multiple creators. I think they're having fun.
Which is so funny, too, because we know your son also started a FinTech company that focuses around investing and poker as well, though that's the saving side of things. I do want to ask, though, because you were so early. In February, you told me that you were worried about leverage in the market. That was before Archegos. So what are you worried about now?
At the end of any cycle, leverage is the thing that usually takes people out. Because leverage makes you make the exact decision you don't want to make at the point, you don't want to make it. And so we run, as a company, we run a debt-free model. We run a pretty cash-heavy model. We have never had a piece of leverage on the firm from the day I started it. We've been through 2 crises, and instead of reeling from those crises, I believe the firm accelerated because our firm is prepared. The model is prepared for acceleration out of the cycle, and we're seeing that in COVID too. I mean, COVID was a disaster for people health-wise, but the business itself is in great shape and accelerating. And I believe that has to do with your whole question, Sonali, about debt. Debt is somebody else's ability to affect your business at the exact moment you want to be left alone, and that's when things surprise you, and you're not ready for it. So it'll happen again. Look, we'll cycle out of this, and it'll happen again.
The Archegos will happen again, you mean? Or something like that?
Something like Archegos. I never would have guessed, by the way, I didn't see Archegos. It's funny. People are very creative, and they'll figure out a new way to hide leverage, use leverage. And I'm always one, again, I'm 40 years in the business. And when something like an Archegos happens, even when Madoff happened, I was one of those people who said, really? Really, that was going on? And so never underestimate people to devise a way to hide the risk they're taking. Because if you can hide the risk and just show the reward in a bull market, again, it's like that. People are paying a lot of attention to reward in a bull market. And so if you can hide a bit of how you're getting an excess reward, you'll get a lot of activity and a lot of focus on yourself. But it'll come out.
What you're saying in this global craps game of a stock market, are you worried that people are still individually taking on too much risk to play in this casino?
No, by the way, I was talking more to the meme stocks as a social event. I think the rest of the market is usually a pretty rational market in which people are. I just say that I think the meme stocks have divested themselves from that. They just said, let's take these symbols and go off and just have fun. and I don't begrudge them that. I think it's there's why not, and figure out your own game. Look, I don't see the excess leverage in the stock market right now. I think people are being I think there was a buyout done yesterday. There's 50-50 equity and debt for private equity firms on a large deal. It doesn't feel excessive. And I have to say the restructuring world, we have a big restructuring team. It's slowing down dramatically as capital's available and people are replacing equity with a debt with equity. So again, I don't see it. I just wonder where it is. Could it be in places I don't see? Could it be deeply in the crypto world? I just assume there's leverage lurking somewhere where I'm not fully able to see it.
Well, since you brought us there, when it comes to crypto, how are you thinking about it? We just saw the first $1 billion deal happen in this space. Does it make sense for you to be either investing your own personal money in it or starting a business at Moelis that starts to address cryptocurrency markets?
Maybe on the personal side, definitely on the business side. We are focused on having expertise, and we do. It's a big market. There's a lot of capital in there. There's a lot of projects in the space. There's a lot of people trying to make it, improve the rails. So as I said, it's like the gold rush of 1848. A lot of people didn't know if there was gold in the ground, but Levi's made a business selling jeans, and Wells Fargo made a banking business selling banking. And I believe our business is selling the picks and the shovels. So, we have to know what people want, what picks and what shovels they need, what tools they need to be successful, and try to provide them. And then just watch the space and try to continue to learn. I'm trying to keep track of it and stay up to speed with it. And I wouldn't say I'm a total believer or total non-believer.
So you've been on the cutting edge of some of these most recent kind of, movements in the market, if you will. In crypto, you're talking about now meme stocks, but also SPACs. You have a bunch of your own, let alone Moelis & Company advising on many deals. We've seen some pretty wonky deals lately, as well as some really big ones. If there's anything that investors should know about how this market is evolving, what would you say?
Look, I think we've gotten through this. In February and March, there might have been a feeling that a SPAC was a magic bean that turned a company worth X into a company worth 2X. It's just not true. It is a wonderful mechanism to reverse engineer an IPO, to do the front end. Look, when I went public in 2014, I had to put all my financials out and wait 7 or 8 months for the pricing. That's a long time to be exposed for an entrepreneur who, your company secrets, your employees, your financials. The good news about a SPAC is it's reversed. You do your financials and your marketing in private, and you announce when you've already orchestrated a deal, and then you put that in the SEC for 4 or 5 months afterwards. That's much more comforting to somebody who's got big plans. And it costs a little more. Yes, I know there are some of the TV announcers who harp on that. Yeah, it's more expensive, but I'll tell you, it might be worth it to get your deal locked up 6 or 7 months earlier and know what your capital is and know what you have. People will make that choice, and it will be volatile because the SPAC market is not an M&A market. It is really an IPO market. The entities that are coming through are entities that are going public in a sense. When you say, let's say a SPAC we control buys a company, we really don't. We transfer our capital to those managers. They go off and run the company. And with our capital, and we've taken them public in a virtual way, by the way, which I think is extremely exciting for boutique banks. We're doing that without a trading floor, without the billions of technology spend. And it's really an unbelievable opportunity for a bank like us to participate in the capital markets in a very big way.
I can't let you leave us without also getting your global perspective here, Ken, because you're an investment bank that, like some others, has been looking into China. You yourself, your firm has advised, for example, the Hong Kong Stock Exchange when they tried to take over the London Stock Exchange. So how do you think in this new era in the U.S. with President Biden in place, the calculus will change when it comes to financial firms thinking about China, when people looking at deals involving Chinese firms?
I think a relationship with China will change business in a very fundamental way over a long period of time, 5 to 10 years. I think if you look back 15 years ago, the emergence of China was all about, hey, how efficient can we make our product? And it was efficiency. It was, if we can make the product cheaper and ship it, we can bring down pricing. And, even components of houses were being made in China and shipped over here for the housing market. I think in the last few months, with the concerns about supply chain and the speed to market, and I think it's even being led by Amazon, same-day delivery, speed to market is becoming a much more higher desire in the consumer's eye. And I think supply chain becomes a big issue. And as companies focus on replacing efficiency with resiliency in their supply chain, we're going to see a dramatic move as to where people want to manufacture their products, meaning how resilient am I? If there's a shutdown, if there's a blockage, if something were to happen in the world of politics, what happens to my supply chain? And we're going to see a real build of resiliency put in the system. And I think that's going to be just a trend that will have a big effect on the economy for the next 5 years.
Well, yeah, what does this mean in terms of inflationary effects also? Are your clients preparing for something that could be more drastic than maybe some are counting for?
Well, I do think you're seeing inflation, but I've been a deflationist since the last crisis. I have to say, over time, I'm still a deflationist. The amount of efficiency taken out by technology is just mind-boggling. The fact that we're doing this conference, the cost of you talking to me right now is probably in the micro pennies versus me flying in last night, staying at a hotel, having dinner, blah, 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 flying back. I'd say we cut the cost down. And for those watching, if anybody is, thousands and thousands of people doing the same. So technology is an unbelievable deflationary force. Now, the supply chain problems that we're having and that will be redone over time will result in things like lumber and items that we can find that are having supply chain problems jumping and appearing, I think, and could be actually show up in the numbers in a large spike in the short term because of that. But I'm still, my gut is that technology wins. And if anything, COVID accelerated technology, accelerated innovation around technology, and therefore the surprise that might come out of all this is an acceleration in deflation once we get past the supply chain bumps that look inflationary, and those are just shortages, I think.
Ken, it was so great to spend so much time with you today. I wish we could spend another hour. Thank you for joining us for our Bloomberg Deal Summit. That was Ken Moelis, CEO of investment bank Moelis & Company.
Great. Thanks. Good to be here.
Thank you.
Hello, I'm Krista C., a reporter at Bloomberg News covering IPOs, SPACs, among other things. 2021 has been a year of IPO, with more than 500 companies going public in the U.S. compared to just 75 from the same period last year. It's also a record year for direct listing, where Coinbase, Roblox, among others, chose that path to go public, as well as a year of SPACs, special purpose acquisition companies. And on this going public panel, we have three guests who have lived through all these paths and tell us why they came to the conclusion that that's the right way to go. And joining me are Alesia Haas, CFO of Coinbase, which went public through a direct listing, Betsy Cohen, chairman of FinTech Acquisition Corp, which took eToro and Perella Weinberg public, as well as NYSE, New York Stock Exchange, Vice Chairman John Tuttle. Thank you for joining me.
Thank you.
So let me get things started. And I want to start with Alesia. Coinbase could have gone with any route, and you guys chose a direct listing. Can you tell us why?
The first thing I'll just share, Crystal, is that we looked at direct listings versus modified IPOs, and I would say that there's an increasing blurring of the lines. I mean, John can speak to it, but the NYSE now permits direct listings to raise capital. We've seen deals where the lockups have gone away with a traditional IPO, and so the lines were getting closer and closer together. But what ultimately came down for Coinbase is the pricing and the allocation of shares decision. And in a direct listing, the market decides. Anybody can participate in a direct listing, whether you're a retail investor, institutional investor. It's open to anyone to submit a bid. And that really spoke to the ethos of crypto to us in an open financial system, and was our deciding factor for the direct listing.
Right, so going public is often about providing liquidity to either early investors, employees, and direct listing, like you said, is a very it's a great way to do it because anybody could sell on day one. My question is for John and Betsy. So how are the IPO and the SPAC competing in the aspect of providing liquidity fast?
Sure. Well, maybe I'll start, and then Betsy, I'll turn it over to you. But what I'm most excited about, and I think what we're most excited more broadly for the capital markets, is that there are options. And so if we had the same conversation several years ago, we wouldn't have been talking about direct listings or SPACs. And so I think each one of those pathways has their benefits and has some trade-offs along the way. And as companies think through their near-term, mid-term, and long-term objectives, both from a liquidity standpoint, a strategy standpoint, et cetera, they will choose the path that's best suited for them. So in the direct listing, of course, you have liquidity, efficiency of pricing, et cetera. But for other companies, the IPO is the well-worn path that they're most comfortable taking. Also, now we've seen emerging with Betsy and others, the SPAC becoming an important tool for companies to think about financing and thinking about coming to the public markets. And so it really depends on the profile of the company, their objectives over a period of time. And also the last piece is how important it is to get a transaction done on a specific timeline. And so that's where the SPAC can bring benefits that kind of the temperamental IPO market may trade off a bit. So I'll turn over to Betsy because she certainly has some unique perspectives specifically about SPACs.
Thanks, John, and I do agree with John exactly in what Alesia was saying, that each company has different needs and therefore has to evaluate which path to go down. The IPO has been the traditional route. Coinbase, I think, really set the level for the direct listing, but it was in a way because Coinbase could talk to itself not only about its investors, but the company itself was able to, that the public was able to make that kind of assessment of value. The company had been around for a number of years and certainly not something for a newbie on the street to do. But the SPAC does offer certain benefits in terms of additional liquidity, control of market timing, the investment profile of primary investors being long-term rather than short-term flippers, I guess they're called. And so, and the primary aspect, I think, that differentiates the SPAC from both the direct listing and the IPO is the ability to converse with investors about a forward look for the company. And that for companies that are in a high growth mode or companies that have significant value but are growing is a very important part of their story.
Right. I do want to follow up on the IPO and liquidity. Some of the IPOs these days have interesting lockup structure, whereas some of the employees could sell on day one, or, you know, like Coupon's case, they have, once the share price strikes a certain price, you know, early investors can sell. John, I mean, there seems to be a want from investors in IPO to provide quick liquidity. Are we going to see any more like innovation in that regard? What do you think we're going to see?
Well, we're going to continue to see innovation and evolution in the capital markets. And I'll go back to a point that Alesia raised earlier, in that a lot of the lines are blurring. Not only do we have various pathways to the public market, so the SPAC, the IPO, the direct listing, the primary direct listing, but within each one of those pathways, you're continuing to see innovation and evolution. And so you talk about lockup periods and liquidity, and traditionally it had been this 6-month or 180-day lockup period. And now you're seeing more and more dynamic lockup periods. If a company meets a certain threshold, then a certain corporate action will take place. You're also seeing, if you look at the direct listing in particular, some companies deciding to put a lockup in the direct listing. So Palantir is the chief example of that, the first one to do that. And so we're going to continue to see the evolution, and companies are going to communicate with their investors, with their shareholders, and think about their overall liquidity and financing needs and determine what structure and framework is best for them as they move into the public markets. So short answer is yes, we're going to continue to see innovation and evolution when it comes to liquidity and lockups.
Right. Well, moving to a different subject, which also is a hot topic, is projection. So SPACs can companies that go public through a SPAC can market forward-looking financials because it's technically a merger, not a listing. There's been a lot of noise about, SEC looking at it. John and Betsy, where do you think this projection piece is going to look like in a few months' time?
I think that the SEC is going to move forward. It's a regulation of projections and align it much more closely with the IPO and direct listing requirements of information that has to be put forward. I think that's a good thing. I think projections should not come out of the air.
I agree with Betsy. You're going to continue to see regulation evolve, particularly when it comes to the ability for a SPAC business combination to provide forward-looking projections and increased accountability for those projections. So, whether it be to be determined regulation or even what has been floated with removing some of the safe harbors and provisions provided by the private securities litigation act from several years ago, there will be evolution. You will see regulation come more and more into this space.
Right.
Alesia. Oh, sorry. No, I was just going to add. I think it raises the question of what companies can use a SPAC if the projections are in fact held to the same standards as John was describing.
Right. I want to follow up on that, but before that, Alesia, why did marketing a deal through a projection not an attractive feature for Coinbase?
Well, I think it starts with our business. And so I just want to echo the points that Betsy and John have said. It all comes down to who you are as a company, what your business is, and what your objectives are. But Coinbase's business is very difficult to forecast. We're inherently volatile. And so providing a long-term forecast that investors could really lock onto wasn't part of our core marketing strategy. We provide outlooks, we provide scenarios, but we were able to do that under the effects of guidance and a traditional direct listing or modified IPO route. And so the SPAC didn't provide that incremental benefit to us.
Right. And it's interesting that you guys said some companies, it should be regulated what kind of company should be able to use the projection. Any opinion on like who should and who shouldn't?
Is that just open?
Yeah, go ahead.
I think that projections have to be grounded, and they have to come from someplace. And to Alicia's point, in terms of outlooks versus projections, in a volatile business, one might not have the ability to make those projections and ground them in past history until such time as there might be diversity of income streams, or there might be other elements which dampen the inherent volatility in the business itself.
Right. Let me take that one step further. John, do you think there will be, the leveling of the playing field where they will eliminate projection altogether, whereas IPO, direct listing, and SPAC are all in the same standing?
I don't necessarily think so. I mean, these are different types of transactions. One is an M&A, and you register an S4 versus an S1, which you see in the traditional IPO or direct listing process. So I don't think they're going to mirror each other, but I think they're going to move towards each other. When it comes to SPACs in particular, Betsy made a great point. I mean, these projections are likely going to have to be more grounded or defensible. Some of that may come via regulation from the SEC. Some of it may come via removal of certain safe harbors for the transaction. So they're not going to mirror each other perfectly, but they will converge when it comes to eliminating any perceived regulatory arbitrage between the different paths to the public markets.
Right. And in the topic of arbitrage, I want everyone to weigh in on this one. Is there a valuation arbitrage if you go down either route? Should we start with Alesia?
Oh my goodness, what a loaded question there. Again, I think it depends on the market. What environment are we in? It depends on the company, the industry. How many comps are there? How easy is it to value this company compared to other companies? I mean, Coinbase was the first crypto company. Our comp set was not necessarily clear and not necessarily the same amongst all investors. So I think that it can't just say it's the structure. Is it an IPO? Is it a direct listing? Is it a SPAC where there is valuation arbitrage? I think there's a lot of factors that play into that. And I think it would be foolish to just think that one should go down a path just for valuation alone.
Right. I wholeheartedly agree with everything Alesia just said. But I would also say one thing that really drives valuation or gives a clear valuation of a company is liquidity. And how many, what is the offering size? What is the public float? What is available out there? What is the supply and demand? And anytime you have a huge supply and demand dislocation, you're likely going to have a dislocation in valuation. And so when you think about one of the benefits of the direct listing in particular, is that oftentimes there is more liquidity in the marketplace. There are more shares available to buy and sell, which ultimately means you're having better price discovery and more closely aligned with the market's true valuation of a company.
Right. Betsy, a lot of people think, because SPACs have a timeline, therefore they're probably willing to pay up. Is that right? Is there a valuation arbitrage?
I think that it depends upon the sponsor and depends upon the willingness of the company to recognize that the valuation should be one which allows investors in the market to benefit as well as the company. And that adds to the certainty of execution, as well as other elements in the transaction. So it's not, it may be that there are certain sponsors who are reaching the end of their period of time and in a moment of desperation are trying to woo a particular target with a high valuation. Both the sponsor and the target should be very wary.
I would also say, Betsy raised a good point about execution. And so, yes, you can announce a deal at a certain valuation towards the end, but that does not necessarily mean the transaction's going to get done. What is in the best interest of shareholders? And so you need to come to market at a valuation that some of your current shareholders are going to support, new shareholders are going to support, whether they come in as part of the business combination or part of a PIPE. And so there is a market correcting factor here that if valuations do move too far astray, there are certain levers that the market will pull to bring them back in line.
I think that John's absolutely right. And it's one of the elements of a SPAC, which I think is very helpful to the company in a way, that the company has the opportunity to talk with investors about the valuation before announcing the transaction. And that, of course, is helpful in getting it right for investors, but also recognizing what current market conditions are. Remember, the market is not static. When you conceive of a transaction and when you actually execute on that transaction, the market may have done things you could not imagine.
Yes, that's a great point. Betsy, you have taken a lot of companies public, and it's from very, very different, background as well, like the very traditional investment banking business versus the relatively new online trading platform. Is there any sectors or any stages of a company that is like a sweet spot for SPACs, or are there any ones that should never think about going public through a SPAC?
I think there are many that should not think about going public. And we try very hard to weed them out. We think about companies in terms of public readiness. Do they have those elements that the public should be responding to? Recurring income, good management in place, corporate infrastructure, enough history to make projections grounded, et cetera. So there are many companies that are ready, and there are many companies that are not.
Right. And there is also like this criticism that SPACs are taking companies public a little bit too early. John, I also want you to weigh in. Do you think that is a fair criticism? Have we seen these cases, and any way we can avoid that?
Well, it's tough to paint it with a broad brush like that. I'm sure there have been plenty of cases where a company was not necessarily ready for the public markets, whether it came from a management standpoint or just being ready from a financial and governance standpoint. But many of the companies are ready. And, that's one of the things SPAC sponsors have to think about when identifying a target. Is this company ready for the public markets when it comes to being able to have predictable revenue, when it comes to having a management team that understands what it's like to go through an earnings call, and then to engage with analysts and public investors. So yes, I'm sure some companies have gone public too early, but there are many companies that are ready for the public markets, and this is just the pathway that they choose to get there.
Right. And Alesia, internally, how did you guys decide that, this is the time, 2021, this is when we're ready?
We really wanted to bring more transparency to crypto. And we were a company that had our controls in place, that had our management team in place, that had thought really hard about what it took to become a public company. And the journey started much earlier than 2021. I mean, we were on this path for over a year, but ultimately decided it was time that crypto had emerged as an asset class that was broadly ready for the public markets and wanted to take that step forward.
Right. I want to go back to SPAC a little bit because the biggest news over the past week is Bill Ackman's SPAC. He raised the biggest SPAC and looks like he's going to close the biggest deal ever, with a little bit of a twist where he used only part of the cash that he raised through the SPAC, and the remaining of it that is not going into this Universal Music deal will be spun into a different listed vehicle. I want both John and Betsy to weigh in. How does this whole structure fits into the scheme of SPACs? Are we going to see more of this? Anybody's going to copy? Betsy, are you personally thinking about doing something like that?
Go ahead, Betsy.
No. I'm not sure that I have the fortitude, shall we say, to do something like this immediately. But I think it's indicative of the fact that this is really, that the capital markets are enormously innovative, that they respond to particular situations, and they're plastic. And I think we saw the plastic being stretched in this particular transaction, but in a very creative way. Will there be others that will follow? I'm sure. There will be those that will try. Will they do it with success? I'm not quite sure. Will rights be substituted for warrants? Possibly. The SPAC is simply a legal structure which reflects the opportunity that a company that is both public ready, as we just discussed, but also has generally a high growth profile, is looking for, how one accomplishes the execution of the infusion of capital into that company, will have many forms.
That's exactly right. And Betsy hit it right on the head when it comes to the capital markets. They're incredibly innovative. And as long as a transaction meets at least, 3 criteria, in that it fits within the regulatory framework of U.S. securities laws. Number 2, it's in the best interest of public investors. And number 3 is it's in the best interest of the issuer. Then we're going to continue to see these types of innovations in the capital markets.
Right. We've never seen this rights being spun off before. Does that satisfy our SEC rules and NYSE rules, John?
Well, all those are done by our independent. All those reviews are done by our independent regulatory arm. So it wouldn't be appropriate for me to opine on a pending transaction.
Right. Well, we'll see how this transaction closes. But going back to, going back to our main discussion, again for you, John. Venture capitalists like to criticize that IPOs, pops are bad and that they're leaving too much money on the table and prices are never right. Are SPACs and direct listing a good solution, and are there actually any other ways other than the SPAC and direct listing to mitigate that pop?
Well, so taking a step back, what do companies value? What are their objectives? So are their objectives to go public to raise capital? And if that is the case, they have the IPO, and the folks that are pricing IPOs are the best in the world at what they do. But oftentimes where the market values a company on day 1 or week 1 is different from where they priced it the night before. Is the company more interested in accessing capital through more of an M&A type transaction and having certainty around the valuation and the price, and maybe a SPAC's a little bit different for them? Or does a company want to have all the benefits of being a public company without necessarily needing to raise capital? So they want the liquidity for their current investors, they want a share currency for M&A, the branding, the visibility, and the stamp of approval that the public markets bring along. And that's an opportunity for a direct listing to be there. So it really depends on what the company's hoping to achieve. Now, if companies are looking for efficiency of pricing and also looking to raise capital, so bringing together the best of the direct listing and the best of the IPO, that's why we work to create the primary direct listing. So it wasn't a solution in search of a problem. Following the successful direct listings that had taken place, I went out and our team went out and spoke with companies, investors, and other stakeholders in the capital markets and determined, is there a need? Is there a desire to have that product that has that efficient pricing, democratized access, and the ability to raise capital? And the overwhelming answer was yes. So we worked with the SEC for 14 months to shepherd through exchange rules that now allow that to happen. So again, it just shows continued capital markets innovation. And for companies that value efficiency of pricing and minimizing that pop and potentially having a lower cost of capital for their transaction, they now have one or more options.
Yeah, for Alesia, this is what John is describing, the direct listing 2.0 with the capital raise. You guys did not choose that. Instead, you guys, opt to do a financing after you went public. Can you talk us through that decision?
That's right. So we've had the opportunity, as we talked about, to raise capital through the public markets, through an IPO, through a modified IPO. Ultimately, we didn't want to be the first to take this path of a direct listing with capital raise because we were the first crypto company and we really wanted to see where the stock would trade once we were public, once we were fully liquid, and really get to that stabilized trading before we then raised capital. And so we decided to go through a convert because it enabled us to get public for all the reasons John just mentioned, find the right stability in our pricing, and then raise capital when we knew what the dilution would be. And we thought it was a very low-cost capital and efficient structure to add on to our direct listing.
Right. And thinking back, if you have to change one thing for this direct listing process, anything you would change?
Oh my goodness. The hardest part of a direct listing is connecting the supply and the demand. You're not allowed to ask your investors what they plan to sell. And so you go in with a lot of unknowns, and that creates volatility, that creates a bumpy path. And so we spend a lot of time educating our employees, but the market does not understand these dynamics as well as I would like them to. And so I think over time, as there's more direct listings, I think perhaps there could be some changes to Reg M that would enable more about potential supply. But that is the most difficult part, in my opinion.
Right. And now that we've discussed all three paths, I want all of you to weigh in. By the end of this year, what do you think the going public scene is going to look like? How many companies is going to go through the SPAC, the direct listing, the IPO route? Should we start with Alesia?
I would need a crystal ball to be able to predict that. Look, I think the capital markets are continuing to have strong momentum. I think the innovation is there. And I think that companies have the ability to carve their own path and figure out what are the most important aspects to them and then create the structures to enable that path. So for Coinbase, it was getting liquid, it was having low dilution, and we were able to achieve that with a direct listing plus a convert. For other companies, they may want speed to market, and so they may choose to have that pricing clarity and speed and go with a SPAC. But I think it will depend on who wants to go public, what their goals are, and then we'll see people land in the variety of structures available to them.
Right. John, what's your split?
I agree with Alesia. I would say, look, there's a lot of SPACs in the market right now looking for targets. So there is capital and there will be business combinations that take place via SPAC. So, if I did have a crystal ball, I would project it, over the next 12 to 24 months of being anywhere, probably about 60% IPOs, 30% SPAC business combinations, 10% direct listing or other. But again, if I had a crystal ball, I would be running a hedge fund, not necessarily listing companies.
All right, Betsy, what about you?
Crystal ball, I would be joining that hedge fund.
What's your split, Betsy? What do you think it's going to look like?
Well, I think that one factor that was not touched on is the fact that there will be, with this number of SPACs in the marketplace, there will be failures. And so perhaps if one rings out what I think might be a 30% failure rate in terms of getting a target and getting it to the market, maybe I would be a little bit higher on the SPAC and a little bit lower on the IPO. But the capital flows, consumer demand, it's the participation of retail, all of these things are unknown and unknowable. And so I think we just have to wait and see.
Right. Well, we have another 6-ish months to see whether John's prediction is going to be right. But any final remarks? Anybody thinks we have missed anything that we haven't discussed about going public?
Look, I think for too much and for too long, people and from all different parts of the market had had talked about the benefits of being private and why it's so great to be private, but there are a lot of benefits of being a public company. And yes, I am at the New York Stock Exchange, so of course it makes sense for me to say that. But the discipline it instills from a financial standpoint, from a governance standpoint, are good for the long-term health and sustainability of companies, and also allowing individual investors or institutional investors an opportunity to be part of a company's success earlier on in their life cycle is a net positive.
Right. And the last question really for you is John. John, there's this online debate of whether how you pronounce NYSE. Is it NYSE or NYSE?
NYSE. There it
Loud
is.
and clear, NYSE. All right. Great. Well, thank you so much for joining me. Thank you for making time, and thanks for joining the Bloomberg Deal Summit.
I'm Katie Roof from Bloomberg News in San Francisco, and I'm interviewing Joey Levin, CEO of IAC. Thank you for joining us, Joey. So the age-old question in M&A is always build it or buy it, which I feel like is the perfect question for IAC because you do both. You built Tinder, you bought Angie's List. So how do you know when to create something in-house or when to purchase it?
We don't. It's all situation specific. I mean, generally, it's much less capital up front to build something in-house, and you can build it exactly the way you want it. So if you can build something, you'd always prefer to build something. But building is hard, and I have enormous respect for the people who take those first steps in building and taking something from nothing and turning it into something, and that buying is going to be a more frequent option and an easier option, but we would always prefer to build where we can.
So any hints on what you're building next? I know you have something called NewCo where you incubate new companies. What's going to be the next Tinder or Vimeo?
Yeah, I think we're building a few things right now in NewCo, which we love. We're trying to start between 3 and 5 businesses a year in NewCo. We have a team that does the ideation, does the research, and does the initial stages of building. And then when something gets some traction, really recruits a new team, or sometimes there's an idea or passion person in there from the beginning who takes that and turns it into a real standalone company. We've got one we're playing around in sports and gaming, one we're playing around in healthcare, one we're playing around in the renovation space. That last one actually is related to not related to, but we have a business already in that category called Angie, and so that's one example where we can sort of do innovation outside the company, which is already operating and is sometimes harder to innovate inside of. And then there's other ones that are totally greenfield spaces for us where we've never been, and that's pretty exciting. But we're debating now actively something I'm pretty excited about. A lot of us are pretty excited about, which is turning the incubator to focus very, very heavily on crypto, which is, I think, a really exciting future in a lot of different categories.
Why are you so excited about crypto?
Well, it reminds me of changes like web and mobile, which were so fundamental to how certain categories evolved. It wasn't changing the dynamics of the category. It was just a better way to deliver. So web and internet was a better way to deliver services, like ticketing was an early one for us, or travel, or really every category. Obviously now internet is fundamental, and web presence is fundamental to delivering a service. And then that next phase was mobile, and Tinder actually came out of our mobile incubator. That incubator was designed to build mobile businesses. It was right after the iPhone came out, and it was right after the App Store came out, and all these apps were being developed for the App Store. And we said, let's build in this area and focus businesses in this area, because we think it's a better way of doing things and a fundamental way of changing the people changing the way people interact. And I think the same could be true for crypto and how it changes the way industries operate. It just makes them more efficient. Some of the fundamental underlying things there are better ways of doing practices that have existed for 50 decades or centuries are just going to be more efficient when done when done on a blockchain.
So are you going to buy anything in crypto? What kind of acquisitions are you planning to make?
We're looking at some things. I think it's really, as you know, very hot right now, and so I think it's going to be very difficult to find anything that's risk-adjusted, affordable. But we're definitely looking at things and would love to buy something if we could. I think that's probably unlikely, which is why I like the idea of building better.
So things are just too expensive right now. Is that because tech valuations are so high and they're choosing to go public?
Price always is stating the obvious, a product of supply and demand, and there is a significant amount of capital chasing companies right now. There's I don't know what the number is now, 150 billion or something in capital in these SPACs. There's capital that used to be there was what used to be sort of venture capital, and then a little bit growth equity, and then private equity. Now all pools of capital are chasing these private markets and these valuations, and moving very quickly. And it's great for I think the ecosystem overall, in the sense that big ideas and ambitious ideas and transformational things are getting funded in ways that having $1 million of runway to pursue an idea is different than having 300 million of runway to pursue an idea before you prove something. And so people can tackle ambitious problems with ambitious agendas, given the amount of capital that's going after it. I think that's all good, but there is just a lot of capital chasing things right now. And so, yeah, price is definitely reflecting that. And as with interest rates at zero, just the price of risk, or the risk premiums, are much lower, and so that's leading to things being much more expensive.
So do you think prices can come down or should come down? Are they too expensive?
I think they will,
Are we
yes. I mean, but I think they will. I don't know when, and if we knew when, that would be a easy way to make money. I do think they will. I think underlying economic things are great right now. People are spending money. People are excited to spend money. People are working. People are, I think there's a general sort of inflation in terms of, we could just see it across all of our business, wages going up. So the things in the supply chain are all really expensive because everybody's spending so much. I think that's all, feels good and healthy. I mean, other people smarter than me will figure out what that means for inflation and how to deal with inflation. But I think that all those underlying things are good. But I don't think risk is well priced right now. I think that people are just presuming that everything goes to the moon, and not everything does go to the moon.
So most people think of IAC as investing in internet-related businesses, but recently you invested in MGM, and you're, from what I understand, betting that Las Vegas is going to come back, and it's sort of a real estate play. Can you tell me more about why you did that?
Sure. So Las Vegas is back. That's amazing and fun to see. But we believe two things, and we wouldn't have done the investment without both. One was that the business would come back, that the world would come back to normal at some point, and that MGM had the capital to make it from the depths of where things were in spring of last year to today. And that part has already proven out. The second thing was that there was some optionality on an exciting new business. And so you say it's a real estate company and not an internet company. It's certainly significantly more physical than it is digital. But the digital business, MGM as a joint venture, they own 50% of what is now one of the leading online gaming platforms in the U.S., and that business is growing phenomenally and is a really exciting place to be. I think it grows for a very long time, and there's lots of places that I think it can go from there. And that optionality was really critical for us in getting excited about it. And we're also really excited, always have been, and continue to get more excited about the interplay between physical and digital. And MGM has these properties where they have a great entertaining experience with gambling, a great entertaining experience with food and entertainment, and beautiful properties and beautiful designs. And then there's this digital thing where you can interact with the brand when you go home, on your couch, on your way home, or as you build loyalty. And MGM has this incredible loyalty platform. You can increase your loyalty points by continuing to play with the brand no matter where you are, and then cash in on that in a physical experience. That digital to physical bridge, I think, is going to be very, very exciting for consumers. To be able to do something fun at home and play and build that points with the brand, and then be able to cash that in a physical experience, is nobody else has that.
What about Turo? I understand you made an investment there, another in-person experience, I guess, with car sharing. Why did you make that investment?
Turo, we saw, was a marketplace business in a very big category that was ripe for, we thought, disruption. Very few people a few years ago, or really at any point, would say, I really love my rental car company. I really love the experience of renting a car and going to the counter and filling out forms and all those things. And I really love having, a white Taurus to drive around town. What Turo brought was incredible, unique inventory that you couldn't get anywhere else. Widely dispersed inventory, so the cars exist in people's driveways all across the country, and a better experience where you're interacting with the owner of the car, and it's much more personal. And it benefits from, of course, scale. We look for products where scale improves the product, not just the price. That the fact that you have, or they're on a path to having ubiquitous inventory across the country and hopefully eventually across the world, means that people can get to a car or get to the right car for them much more easily. The bigger the business gets, the better the experience is for everybody on that platform, and the better it is for the hosts, because they're more likely to be able to earn income on their car. And we were seeing all these great stories on Turo, too, of people who couldn't use it. I have a friend who couldn't use his car because he had knee surgery, so he literally couldn't drive for a month. So not only is he laid up, but he's got this thing that he's paying for, which is a car in his driveway, and now he can turn that into an income-producing thing, which he did. And that's a phenomenal experience for somebody. And most cars are severely underutilized. So you've got a thing that's taking advantage of a network effect, using a severely underutilized asset, and delivering a phenomenal customer experience. If you look at the Net Promoter Scores, it's very impressive on that business. And the combination of all those things was very attractive to us, and we thought big opportunity to disrupt, and we're excited about it.
So what sectors are you going to invest in next?
I don't know. As I mentioned, we're spending some time around marketplaces having to do with NFTs, or marketplaces having to do with things that exist on the blockchain. I think that's really exciting. We're spending time, we always have, around healthcare. We've never really done anything big there, but it's such a big category and there's so much opportunity there. We'd love to figure out how to get started there. Our publishing business called Dotdash is doing very well, and we're looking at opportunities to expand that. We'd love to get something done in that area. And in the home services area, we're always looking to expand. So those are probably some of our priorities. But we've the best and hardest part about IAC is we really will look at anything, any kind of opportunity, and there's lots of different things we're considering right now.
So if any of these investments that you've taken a minority stake in, could at some point these become majority stakes? Are you going to outright buy any of these companies?
Sure. I mean, we say that in any business we get in. We say a couple of things. One, we'd like to own it forever. And own it forever Could mean literally own it forever. It could mean our shareholders own it forever because, I think we spun off a lot of companies and we believe in spinning off companies. And so eventually giving things to our shareholders is something we believe in. But number one, we believe in owning it forever. Number two, we'd like to own more. And we've said that in anything we've gotten involved in, MGM, Turo, and other things, if we're in it and it's working, we'd want to own more.
Yeah, and tell me about your philosophy on spinning off businesses. Recently at Vimeo, in the past there's been Expedia. So just tell me why you do this.
At some point, each of these businesses, it can probably do better on its own. It makes sense on its own. It's got enough stability in its business that a unique currency for that business, it's got enough of a trajectory in the business that a unique currency starts to make sense. Vimeo, the most recent one you mentioned, is in a category. It's enterprise software as a service. That is a category that's very attractive to investors right now. And Vimeo is certainly being aggressive in that category in terms of expansion with employees and expansion looking at acquisitions and things like that. And so to have a currency that's competitive with others in the category, I think is going to be valuable to the business. When we do that, we want the business to make sure the business is in a place where it's capable of being public and it has the financial strength and the sort of predictability to be worthy of the public market. And Vimeo crossed that threshold over the last year or so. And we also look at kind of what's left behind at IAC and whether that has enough heft to make sense. And when those things come into alignment, we figure out a good time to spin.
Will you spin off any companies into a SPAC, or what do you think of SPACs?
Not a SPAC fan. I'm a SPAC fan in that I'm glad that other people are doing them. I'm glad that there's a market to get these companies public, and so a lot of companies will be sort of under the public light, which I think is healthy for a lot of people, that people can invest in these things. People can bet on them. People can bet against them. I think that's all healthy for the ecosystem. I don't think we're likely to sell a company to a SPAC or do a SPAC. Some of the sort of fundamental components of a SPAC don't really resonate with us. We spend a lot of time building companies, and people do unbelievable work to build a company and get it to a point where it's created real value and it's worthy of either further investment or being in the public markets and all that. And I don't really see why you'd go through all that work to build a company and then hand over the keys at a critical point to somebody else. That part is what's confused me and think does not really make sense for us or companies that we're involved in.
So not a fan of SPACs. What mistakes have you made? What mistakes has IAC made? Any regrets on acquisitions you've made or other deals you've done?
Yeah, we talk about this a lot, and our biggest regrets are always mistakes of omission more than commission. We've certainly made plenty of mistakes in both areas, but we've missed big opportunities, and because we've gotten scared or we've doubted ourselves, we've been close to buying things, and then we've talked ourselves out of it and lived to regret that. And those are the ones that I think are our biggest mistakes. Well, we've certainly made many mistakes in acquisitions, deals, and I'm sure we'll make many mistakes more. We try and learn from each one. But also when we make those mistakes, like our philosophy at IAC, as I was saying, is we own these businesses forever. So we have to live with it, which means we don't just get to trade out of it really quickly. It's not that easy for us to trade out of something. So we have to make it work as a business, whatever it takes to make it work as a business. A good example is we bought Ask Jeeves in 2004 or 5, which was, again, hard to believe now, but was a competitor in search, and we certainly badly lost the search game to Google, which won the entire market. But that business, when we bought it, was 75 million of EBITDA, and when we at its peak, we had it doing 400 million of EBITDA, and we had to change it into a bunch of different things and figuring out other ways of making money other than what we had been doing previously. But it was on us to turn that around. We couldn't sell it, and so we had to figure out how to make it work. And so that one is one I'd probably, in retrospect, call a mistake. But we did make we were able to get our capital out of that.
So 5 years from now, what will IAC look like?
I ask myself that question all the time, and I don't know the answer. I think it will be likely a different set of businesses, not necessarily different, there be some overlap, but a different set of businesses than it is today, because hopefully we'll have grown some businesses in IAC and spun them out. And hopefully we'll have bought some businesses that have grown to be real scale inside of IAC that'll be on a path to be spun out in the future. And if we've done that, we'll have succeeded over the next 5 years.
All right. Well, thank you so much for joining us.
It's my pleasure.
Welcome, everyone. I'm happy to have Jeff Smith, the CEO of Starboard Value, here with us today. For those of you who don't know, Starboard is one of the most prominent and busiest activist investors in North America and the world, for that matter. Despite the pandemic, they've launched more than or around a half dozen campaigns in the last year and a bit. And also joined the SPAC craze with their own SPAC, which they merged with Cyxtera earlier this year, which is a data center company. Jeff, thanks for coming on today, and we're really happy to have you here. Let's kick this off with what everybody's talking about these days in the activism world, which is the proxy fight that just concluded at Exxon Mobil. They've lost. The tiny activist engine number one won 3 seats, despite only having a 0.02% stake in the company. And a lot of people are looking at this as a watershed moment for ESG investing and activism in general. And I wanted to get your views on that. Is it a watershed moment for ESG investing, and does it change the way you look at activism?
Yeah, listen, Scott, first of all, thank you for having me. It's great to be here. Yeah, look, I think it is. I don't know if it's a new watershed moment or a continuation of the influence that's been building for shareholders. So we don't have to call them activists, but for shareholders. Shareholders can make a difference, especially when shareholders are doing what we look to do, which is to speak for the rest of the shareholder base. So when there's a disconnect between what the company's doing, what the board is believing the shareholders want, and what the shareholders actually want, there's an opportunity for change and for shareholders to advocate for the interests of the majority of shareholders. Look, what they accomplished is eye-opening, but not all that surprising. We've been seeing this for I don't know, probably at least the last 10 years. If you're a shareholder and you represent the majority of other shareholders, if you're speaking for them, if you're touching a topic that shareholders care about, then you can rally their support. And I think that's what you saw in this situation.
I think what was interesting about it too was the 2 shareholder advisory firms also partially supported their slate. I could be wrong, but a few years ago, I think they typically wanted you to have a little bit more skin in the game before they would award you board seats. Is that something new, or is that something that perhaps is a continuation as well?
Yeah, look, we've been doing this for, as you know, Scott, we've been doing this at Starboard for a really long time. So we're coming up on almost 20 years. It's hard to believe that, but it's almost 20 years now. And yeah, when we first started, this was not possible. When we first started, the knee-jerk reaction from companies, from advisory firms, from shareholders, was to push the shareholders out. And in order to have any credibility at all inside of a company as a shareholder, you needed to own over 5% of the stock. You needed to file a 13D. If you didn't do that, that was table stakes. If you didn't do that, you didn't have the ability to have a chance to be able to do this. But that's changed, and again, that changed. Again, it's probably about 10 years that's changed. I've mentioned this before. When we had a position in Yahoo, it was less than 5% ownership. I don't remember how many years ago that was, but we were advocating for Yahoo to separate their operating business from their minority-owned assets, and the minority-owned assets had tremendous value, a lot more value than the operating business. And I've said publicly, we could have owned one share in that situation, and we would have had the support of the shareholders, because the vast majority of the shareholders wanted that separation to happen. So it no longer mattered whether you had a large stake or not. That was on a business issue. That was a separation of businesses. That was on a value issue. This just happens to be on an ESG issue. But the shareholder was speaking for the majority of shareholders and representing the majority of shareholders better than the board was. And so therefore, the majority of shareholders supported them.
I wonder, though, if it's enough just to get board representation. I mean, how do you keep this credibility going in an ESG world where, BlackRock, Vanguard, State Street have all said that they want to support ESG initiatives? Obviously, just getting 3 people on the board is just a start, right?
Yeah, look, we don't talk about it all that much, but we probably do more for ESG than just about anybody does when we get involved with companies. So what do? You have to really accomplish it. Just like whenever we go on a board, we have to really accomplish our goals as it relates to the operating elements of the business. You have to really accomplish your goals as it relates to the ESG elements of the business, which means coming up with goals that are and metrics which are deliverable and measurable, laying them out and increasing disclosure to show the shareholders that you're making progress against your goals. So, just like if you went back 20 years, if we were going to get involved in companies and improve their operations, you had to prove that you could do it. You had to actually accomplish those goals in order to gain credibility. I think that we're in the infancy on the ESG side, which is if you're going to come in with a platform that says you're going to improve ESG, and again, on the G side, it's probably a little more mature, but on the E&S side, you need to show that you can do that. So if you're going to get on the board of a company and that's your mandate, then you're going to need to disclose your metrics and what you're trying to get accomplished and be measured against those and hopefully be able to achieve those goals. Look, a landmark case for us, you talk about this being a landmark case, but a landmark case for us that everybody was watching was Darden Restaurants. We got involved in Darden, and as you know, we replaced the entire board of the company. First time ever, only time that a Fortune 500 company had the entire board replaced. But that was just the start of it, just like this. And you're asking, how do you get measured? So when we did that isn't the end. The end is actually accomplishing the goals. The whole world was watching. Great, Jeff, Starboard, you replaced the board at Darden. I'm sure there were plenty of corporate executives and defense advisors that were hoping that we were going to do a poor job and then be able to point to it and say, see, activists don't know what they're talking about. Instead, that's not what happened. We got involved, we replaced the majority of the board, and the company has executed unbelievably well. And so, we provided better oversight. We showed the metrics. We changed the operation of the business. We changed the culture inside the company. The management team there is first class, still doing a tremendous job, even without our involvement now, well past when we were involved and helped to transform the business. So, the landmark cases are important, but what follows is maybe even more important. You have to actually deliver so that you can continue that momentum.
Okay, so over the last little while, I'm going to switch modes here, but the the tone of the fights between companies and activist investors has changed a little bit. It seems to be a little bit more productive, maybe a little bit more behind the scenes, much to the chagrin of journalists like me who like to cover, a big bombastic proxy fight. I took from the letter that you recently wrote to Box that you had tried a different approach there. And now, of course, you're in the midst of a proxy fight 2 years later from the initial investment. It looks like you tried to give them a bit longer of a leash, and I wanted to ask you, why was that, and what lessons have you learned from it?
Look, this is an exception for some reason, and we'll dig into it a little bit. But Box is an exception. For the most part, we've been able to work with companies very, very successfully, either by going on the board, being welcomed on the board, or on the outside and work on metrics to transform the business and create a lot of value. So the overwhelming majority of the situations work out unbelievably well. Box is an exception for some reason right now, and I'm not sure what I can point to, but you're right. We made this investment over 2 years ago now, and we were told that they were turning the corner, things were getting better, the operations were going to improve, the value was going to improve, and that the board was going to be able to hold management accountable and be able to make good decisions for the best interest of shareholders. And so, we trusted that. We believed that the management team and the board were telling us the truth, and that they understood that they needed to change how they were operating the business, and that they were going to create value. And so we left, good people in the boardroom to do that job for the best interest of shareholders. And we felt that it would be okay for us to remain on the outside, and that specific shareholder representation in the boardroom may not be necessary at Box. And we fully hoped and believed that Box would be able to succeed on their own and be able to create a lot of value for shareholders. So what's changed? Unfortunately, Scott, as you know, the value really hasn't been created. I mean, the stock really isn't much higher than where it was when it IPO'd, and they've underperformed, depending on which index you look at, they've underperformed that index by over 200%, and haven't created enough value for shareholders from our standpoint, as well as from shareholders' standpoint. So we're left in a situation where we feel like we need to get involved, but still we would have probably tried to figure something out with them had it not been for their latest action, which is a massive head scratcher and probably one of the worst governance decisions we've seen a board make in a long, long time. So that kind of left us in a position where we no longer felt as comfortable.
Just to be clear, we're talking about the KKR transaction where they issued $500 million in preferred shares.
Yeah, well, yeah, and I'll go through some background on it, but we're no longer in a position where we think that the board, for whatever reason, is either has their eye off the ball or doesn't truly understand what's happening, or to some degree may be complicit in it. But the financing itself doesn't make any sense. So let me just take you back a step, and then let's try and pretend we're in the boardroom and tell me how somebody can actually make this decision, because I don't see how there's any valid business purpose for this decision. So let's go back to December and kind of say December, company's sitting on over $200 million of net cash, over $200 million in net cash, and they're projected to produce this year about $175 million of free cash flow. So this is not a company that needs money. They have plenty of money. They're producing a lot of cash, free cash flow. And then in January, they go out and they do a regular way public convert deal. And they raised, in January, I think they raised $300+ million. So $300+ million they raised in January. And the terms of that deal were 0% coupon, up 45% premium. So 0% coupon, 45% premium. And from our standpoint, we weren't happy about that deal. We said, what are you doing this for? Why you don't need the money? What are you doing this for? The stated purpose was to do acquisitions. we believe companies need to earn the right to do acquisitions, and they haven't been able to run their business well enough to be able to prove that they can do an acquisition, not get distracted, and be able to integrate it. They haven't really done acquisitions. They've done, they used that $300+ million or $500 total million in cash to do an acquisition of like 40 something million dollars, which they could have done just off the cash on the balance sheet. That's all they've done. Now, to be clear, I'm not telling them to go do acquisitions. I'm not telling them, oh, Jeff, you're wrong, we're going to do acquisitions. That would be a big mistake. But now they have this war chest. They have over $500 million of cash. They're producing $170 million of free cash flow in the year. And in January, they did this convert deal, 0% coupon up 45. So then in April, when faced with a proxy contest, a threat of a proxy contest, right as our standstill is expiring, they announce a new transaction where they raise an additional $500 million. They already have over $500 million in cash. They're already producing $175 million in free cash flow. They announced they're going to do another financing for $500 million in cash. But the strange part about it, Scott, is the terms are garbage. They're garbage. It doesn't make any sense. So the new terms for this preferred are 3% and only a 20-something% premium. They had just 3 months earlier, they had just done 0% and 45% premium. So if you're in the boardroom and somebody comes into you and says, and you're an independent director, I don't even understand the conversation. Somebody comes in and says, hey, board, we have this great idea. We're going to do a new financing. The first question should be, do we need the money? We're sitting on $500 million in cash and we're producing $175 million in free cash flow. Do we need the money? No, we don't need the money. So why are we doing this? Well, we have a good idea. We're going to do a $500 million new financing. And it's going to have a 3% interest rate, dividend, coupon, whatever you want to call it, 3%. Well, I don't know. I don't understand. We just did one 3 months ago that had 0% interest. So why are we paying? We must be, I imagine if I'm a board member, we must be, if we're paying 3% in interest when we used to pay 0 when we did our last deal, it must be because we're going to get a higher premium. Has to be, right? No. So the prior premium was 45%. This premium is 20-something%. How does that make any sense? Why would you possibly do a deal at a higher interest rate and a lower premium? So maybe things have changed. So maybe you say, okay, so you're coming to us, you have a $500 million new deal you want to do, and it's got a higher coupon and it's got a lower premium. So maybe conditions have changed. So is our public convert, which is out there, publicly traded, is our public convert trading at a massive discount to par? Because we just did that 3 months ago. It must be trading at 1% of par for this to make any sense for us to do that. No, the public convert's trading at 116. So if you're a board member and you're watching this at all, you know that your public convert is trading at 116 with terms of 0 up 45. How do you possibly hand someone a new convert at 3% up 20-something? It doesn't make any sense. You would never do that.
Okay, I can see that you're clearly frustrated by this transaction, but we only have a few minutes left, so I'd like to switch topics if possible. You raised a SPAC of your own in November, had a really quick trade on it, probably 3 months until you found Cyxtera. What was that process like as a sponsor to raise it and then also get into the market and try to find a company that quickly?
Hey, Scott, I don't know if you can follow. You still there? Yeah, okay, good.
Yeah.
So just to complete that, the obvious answer as it relates to the KKR transaction is they bought votes. The KKR deal votes 11% of the shares. They used the $500 million to buy back stock, and they're buying back stock at almost the same price that they issued the conversion price. There's no valid.
I think we had a little technology issue here, but we only have a couple minutes left, and I wanted to ask you about the SPAC that you raised in November and found a target within 3 months. What was that process like, and why were you able to find a target so quickly?
Yeah, Scott, I mean, as we were fortunate, involved in a business where everybody wants to work with us. Everybody wants to work with us because of our reputation, our governance expertise, our operational expertise, that when we came out with our SPAC, SPAC, we had lots of private companies that wanted to merge with us. So it was a relatively easy process for us to be able to sift through the great companies that we wanted to work with. And we were different from others in that we were looking for real operating businesses as opposed to late stage venture companies. We're thrilled to be able to do this deal with Cyxtera. It's a real business, a good business. It's in the data center space. Interestingly, one of their peers, QTS, was just acquired. I'm sure you covered that. And if you look at that, the price that was paid for that, it's a good comparable for Cyxtera, but that was taken out at, I think it was 22 times 2022 projected EBITDA, and Cyxtera is valued at about 15 times. So we feel great about our transaction and feel great about the future of the industry that we're in as it relates to Cyxtera in the data center space, and also the execution of Cyxtera and their management team.
Any thoughts on raising a second SPAC?
You know, it depends. I mean, we're still watching how the market evolves. We are thrilled with the reception that we've received from shareholders and again from the private company community that would love to merge with us. But we're trying to figure out how the SPAC market evolves and where we fit in that and what we want to do.
Okay, well, I want to thank you for taking the time to join us here today, and we look forward to covering your next target and also, maybe your next SPAC.
Thanks, Scott. It's great to be here.
Thank you all for joining us for the Bloomberg Deal Summit. We hope you enjoyed these conversations. Thanks again to all our great speakers and moderators for a great program. Also, a big thank you to our presenting sponsor, SS&C Intralinks, for making this virtual summit possible. If you'd like more information on our sponsor, please visit the Resources tab found in the menu at the top of your screen. And most of all, thank you for being such an engaged audience. If you missed any part of today's program, you can find the replays on the Bloomberg Live YouTube page. Please also visit BloombergLive.com for more information about other upcoming events and follow us at Bloomberg Live and at Bloomberg Deals. And if you find the work we do at Bloomberg News valuable, please consider subscribing at Bloomberg.com/subscriptions. And this week, we also launched a daily deals newsletter. Be sure to sign up for that on your terminal. Thanks for watching, and we'll see you at the next one.